Besides having accounts receivable, companies will also have notes receivable as assets on their balance sheet. Now, a notes receivable arrives because a company that borrows money from your company signs a promissory note that they promise to repay the debt that they've incurred with you. And in many cases, that promise includes paying interest to you as well. You may have heard in the past that the best proof of, or evidence of any disagreement between two parties is something that's been put in writing and signed by both parties. A promissory note is signed by the borrower that shows that they promise to pay you for the principal amount plus interest and when it's due. So a promissory note might look something like this. In the top left-hand corner, the amount of the principal balance borrowed. On the top right-hand corner, where the promissory note was signed and the date of the note. The due date says when is the promissory note due. Pay to the order of who is the lender, the person who's being paid later. The dollar amount, and notice we have it written out both in dollars in the top left-hand corner, but also written in text to make sure that everyone knows for sure exactly how much has been promised to be paid. Also, the interest rate at an annual basis, and finally the last part here is the maker, and the maker is the borrower who has agreed to pay the note. So the question then here is to determine the maturity date of the note, because in many cases the note may be expressed in the terms of months, or it could be expressed in the number of days. Now this will be very important because then we have to compute the interest. If it's expressed in months, the time in terms of 1 year would be the months would be the numerator divided by 12. Whereas if it's in days, the days would be the numerator divided by 360. Note, we're using 360 days for a year, not 365 days. So when we look here, when we're computing interest, if we had a term of a note of $730 at 12% annual interest for 120 days, we would use the computation of $730 times 12% times 120 divided by 60. If you ask why we're using 360 instead of 365 days, take a look at the number of months, and to simplify, if we had 12 months, we would then have equal 30-day periods. Does that mean we're losing interest? In the short term, possibly we might be losing interest, but in the long term scheme of things, this makes the calculation much simpler. Notice here, if it's in months, we use the denominator of 12, and if it's in a year, we use the denominator of 1. So when we recognize the notes receivable, in many cases a notes receivable may occur because a customer originally couldn't pay their accounts receivable. You sold a product to a customer, you gave them credit, and after the accounts receivable became due and you try to collect on the accounts receivable, the customer may have asked you, could you please extend the time to pay? Now, in most cases, our company is not in the position to finance the debts of other companies, but we do want to collect that invoice. So as an accommodation, we might agree to the customer to extend the credit, but we will require them to sign a promissory note that they will promise to pay. Also that they will promise to pay interest on the outstanding balance. The reason why we want that promissory note is now there's no way that the customer can say they did not agree to pay. in an accounts receivable situation, if there was a disagreement, there is a possibility that the customer could go, when they go to court for collection, get out of paying that debt. With a promissory note, we can show that there's a signature from the maker that says they did promise to pay the debt. So as we value the note receivable, just like an accounts receivable, we could have an allowance for doubtful accounts for notes receivable. So if we have an allowance for doubtful accounts for notes receivable, we can apply that balance and subtract that amount from the total notes receivable to determine what the net realizable value is for our notes receivable. Now the question is what happens when the note matures? At the time of the note matures, either the customer pays the note with the interest, in which means we say they honored the note, or they don't pay the note and we say they dishonor the note. The problem that we run into is that if the person dishonors the note, the agreement on the promissory note is to pay interest only for the period of time on the promissory note. So once the note's been dishonored, the notes receivable essentially becomes an accounts receivable again with no further interest collection. Now, one way we can speed up the collection of cash, because we need the cash, is that we could potentially take that notes receivable and sell it to an outside party. That sale to the outside party is called selling the note to a factor. So here's the terminology and descriptions of honoring and dishonoring a note, as we just mentioned. So in the case of honoring a note, we would do a debit to cash, a credit to the notes receivable since they no longer owe the $10,000, and we would recognize the interest revenue for $375. Note the calculation for the simple interest of $10,000 times 9% times 5/12, which is 5 months out of the year. Now, one problem that we run into is what happens if the note does not mature and we have the end of the year. Because of the revenue recognition principle, we still need to recognize revenues for interest even though we haven't collected on a note because it hasn't matured yet. So instead, what we have to do is recognize the interest for the period of time from the start of the note till the end of the fiscal year. We would recognize the interest for that fiscal year and call it interest receivable, and we would have to recognize the interest revenue for those 4 months in this example that shows how much interest we've earned. So we would do a journal entry, debit interest receivable, credit interest revenue. So what happens then, at the time of payment of the note, we would receive the cash, we would show that the notes receivable has been paid by doing the credit for $10,000. We would show that the customer paid us for the $300 of interest that we had earned in the prior period, and then we also recognize the interest revenue that we earned in the current period. So we would do the debit to cash, the credit to notes receivable, the credit to interest receivable, and the credit to interest revenue. So this is how the receivable section on the balance sheet might look for a company that has a lot of different receivables. Note what we did here is we show the most current receivables as the top receivable, and we work our way down to the less liquid. Then, after we get the total receivables, then we apply the allowance for doubtful accounts to get the net receivables, or the net realizable value. So you can see that notes receivables are treated very similar to accounts receivable, and they even have their allowance for doubtful accounts account.